Welcome to the Scalable Real Estate Investing Podcast, where we discuss the most scalable strategies, tools, and approaches to successfully invest in real estate. Learn how to make the most impact of your time, automate your real estate investing business, find off-market deals with minimum time invested, and leverage your capital to create as many income streams as possible so that you can achieve true financial independence. Thank you for tuning in. I'm your host, Mason Klement. Hi, Scalable Investors. Thank you for tuning in to another episode of Scalable Real Estate Investing. I'm your host, Mason Klement, and today I have with me Jeff Holzmann, who is the CEO of a company called IRM. And IRM's a little interesting. It's solely been created to wind down the portfolio of about $1.5 billion that was invested through the crowdfunding platform called RealtyShares. And they have been at it for over a year. And Jeff goes into detail about his experience in doing this and really painting an interesting picture of not just the good side, but also the bad side and what happens when there's bad sponsors on deals. So really excited to have him go in detail and hope you enjoy. Let's bring him in. Record now. All right, Jeff, how are you doing today? As I mentioned,
Very
you're
good.
CEO of IRM. Yeah, so why don't you just tell us what's going on and what you're into, and actually I'd like to discuss with my guests first how you got into real estate and IRM as well.
Yeah, of course, it's actually an interesting story. So I'm glad to kick us off with that kind of question. So IRM is an interesting company. It's a little unique in this space. The name of the company, IRM, actually comes from the letters that stand for the name of our shareholders. The I comes from Into, which is a large crowdfunding platform based in New York. The R is for Reef. Reef, with a double R, is a large owner, developer, sponsor of commercial real estate based in Dallas, Texas, that's been around for many years. And the M comes from management services. So really the reason we exist, it's a joint venture, a 50-50 co-development between Into and Reef. And it was put together about 2 years ago for the sole purpose of essentially operating the RealtyShares portfolio. RealtyShares, for those of your listeners who don't know, was one of the largest crowdfunding platforms in the world. It was a pioneer in the world of crowdfunding for commercial real estate. Started out in San Francisco, California. Slightly after the Jobs Act, raised hundreds of millions of dollars from retail investors, people like you and I, to invest in commercial real estate. Also was very successful in raising venture capital for their own firm. At some point had 150 or so employees, spent a lot of money on marketing. RealtyShares.com was, if you're in the real estate space, if you're in the crowdfunding industry, you've heard of RealtyShares. It was a very, very big deal. And about 2 years ago, they've announced that operations were not going very well. They've essentially said that they are going to stop their operations. They never officially went out of business. They stopped before, but they essentially started looking for other groups with professional experience in asset management, and I'll discuss that, to kind of take over the day-to-day operation. And this deal was a little too big for Into to tackle alone. I actually came from Into. I was the managing director of Into in North America. And we've partnered with Reef on a 50-50 basis, essentially created IRM. And IRM was the company that negotiated with RealtyShares for taking over their portfolio. There were many other companies in the space, in the country, that negotiated with RealtyShares, but we ended up coming out on top. And essentially what we've been doing at IRM for the last 2 years is service the existing customers who invested collectively almost $1 billion, that's billion with a B, in commercial real estate through the RealtyShares platform. So just to kind of give you a sense, we're talking about just over 7,000 investors in tens of thousands of different investment positions, because an average investor at RealtyShares had multiple different deals. We're talking about almost $2 billion worth of assets under management that were still around when IRM took over, in about 250 different real estate projects across the country. Only in the US, by the way. There's no international projects that we took over. Some international investors, but no international projects. Most of those projects are multifamily. That's a very resilient asset category these days, but there's also in the RealtyShares portfolio a single family residential category, what we call the SFR, that has not been going as well, and we'll discuss the statistics. We also have shopping centers, we have office buildings, outdoor malls, self-storage, and even some industrial complexes and things of that nature, but to a lesser extent. Predominantly, we're talking residential, single family, multifamily, and quite a few hospitality hotels, again, around the country. So the team that we've put together at IRM, we have offices in many different locations, including here on the East Coast, where I am, in New York, New Jersey. We have a large contingent of asset managers in Dallas, Texas, some asset managers on the ground in California. We have an entire fund administration department in Utah and a customer service desk overseas, an R&D team in the Middle East. We're scattered throughout. And one of the things that is very unique about IRM and has gotten us a lot of attention is that we have an unbelievable perspective on what's happening in the commercial real estate market at any given time. And again, this is not, we can't take the credit for that. We inherited that portfolio. We didn't put it together. We were not there at the time of underwriting. We essentially took over the operations when RealtyShares basically stopped operating. What makes this entire company unique is there's, like I said earlier, there's virtually no other companies that we know of with this business model, because our business model is to shut it all down. IRM is not operating RealtyShares.com to grow. We're not soliciting new deals. We are not accepting new clients. We're only here to kind of liquidate the existing portfolio. Our goal is to get the RealtyShares investors as much money back as we can. Hopefully return all of their money with a positive return. We've been successful doing that on most deals, not all deals. We're very good at what we do. We've hired extremely professional, experienced asset managers. We don't have a marketing budget. We don't have a sales budget. We don't do anything except try to maximize what they've already done. However, as I say, we're not magicians. We cannot make money out of thin air. And in some cases, it's just a poor investment. We can talk about that. There's a lot to learn from failures, in my opinion. Some bad underwriting occasionally, some bad execution in other cases, and then anything between COVID and all kinds of market variables that led to some investments to fail. And failure is a very broad definition. Some people lost a little bit of money, some people lost a lot of money. It's still a failure, the way we classify it. So just to give you some statistics, currently, about half of the portfolio is what we call tier one, which is performing, delivering positive returns. We're averaging very nice returns. Again, not necessarily to our credit. These are just good deals that we inherited. About a quarter of the portfolio is what we call tier two. It's working, but it's not going to deliver what was originally underwritten, what was originally expected. And about a quarter of the portfolio is what we call tier three, which is not performing. There's probably no cash flow coming in whatsoever. We have sponsors that we are already suing in the court system for various reasons, if it's under the personal guarantee or for some kind of malpractice or misrepresentation. We work with what we can. I think, unfortunately, a lot of people don't understand that going the legal route, there's no certainty of outcome, right? It takes time, it takes money, and a lot of times these sponsors can mount a defense, and it just gets complicated. The lawyers get richer, but you're not necessarily going to make more money at the end. So it's somewhat of an ungrateful job. We have a team of 40, 50 people working around the clock trying to make the best decisions they can every day, educate investors in the process. Mostly it's going very well, but again, there are definitely some situations where, unfortunately, the investment is not a producing investment. So it's a very, for me personally, as the CEO of the company, it's a very challenging position. It's a very challenging role. Our goal was and remains to liquidate everything, and we hope to achieve that within the next year or two. And that's us.
Okay. So when you say you hired asset managers, is that for the bottom threshold to manage those assets, and you kicked out the sponsors that initially raised the capital?
No, not at all, but that's a great question, which is worth clarifying. So at IRM, essentially, our business is asset management because we don't do any underwriting. We don't do any acquisitions. We really don't do any dispositions, and I'll explain what all that means. Our role is basically to oversee the investment that someone else already made with a sponsor. So we are not a sponsor. IRM is not a developer of real estate, right? Our only job is asset management to oversee the sponsors who are actually managing the day-to-day. Now, the unfortunate reality is that we can't just do whatever we think is appropriate based on our experience and our knowledge. We are bounded by the operating agreement that each investor has signed with RealtyShares. And that's the first clue for your listeners. That operating agreement, which is sometimes 50 or 60 pages, and you scroll all the way to the bottom and sign it, that's your first mistake. You want to read that operating agreement. And yes, it's boring. Yes, it's full of legal terminology. But if you are trying to become a more of a professional, a more experienced, more knowledgeable about how the industry works, then you really want to spend time reading that operating agreement, because it literally defines what you are allowed to do, what the sponsor is allowed to do. When does the sponsor have to come to you for approval? When does the sponsor need to report to you? What kind of guarantees, if any, do you really have? And a lot of people just scroll to the bottom, and I'm guilty of that as well. We all are, right? We all scroll all the way down, hit accept, click submit, and because we want to transact. But the first lesson is you really need to read the operating agreement. We certainly did, and we understood what we're walking into, but it is very limiting at times, because sponsors may operate the asset, even sell the asset without requesting our approval. So oftentimes we find ourselves on the sidelines. So to answer your question, what does an IRM asset manager do? First of all, every single asset in IRM's current portfolio has an assigned asset manager. We obviously have fewer asset managers than assets, right? And an average asset manager at IRM will oversee multiple deals. But the more complex the deals, the fewer assets that asset manager will oversee. And that's because they tend to be more complex. If it's a tier one, usually a residential multifamily complex with a professional sponsor, then there's very little to do in terms of oversight. Distributions show up every quarter. Quarterly reports show up on time. K1 reports show up ahead of the deadline. You make a phone call to ask a question, someone will pick up the phone and give you a professional answer. So that's easy in terms of what we do. We still have very professional, experienced asset managers with a minimum of 20 years worth of experience working for some of the largest hedge funds and private banks and asset management firms, FDIC. We have people who work for the government. Our team really knows what they're doing. We're not flawless. We're not perfect. Nobody is. But really, the people that we paid to do this, they do this for a living, have been doing it for a very, very long time. They know the industry, they know the tools, they know how this thing works. On the other end of the spectrum, you have sponsors, and I use that word very lightly. You have developers, people who are the managing member of the entity. You can't get a hold of them. Sometimes they're not even, some of them don't even reside in the country, which is very disturbing. I don't recommend investing with someone who is the sponsor, but they live in Canada, and that's happened. We talk to sponsors who are essentially no longer in business. They refer us to their lawyers, even though the asset is still there. And you're wondering who's collecting the rent, who's deploying the CapEx, who's generating the K1, who's making sure that this thing is paying taxes. I don't know. And we've hired private investigators at times. We've hired forensic accountants multiple times. We do whatever we can with the resources that we have to try to get to the bottom of it and see what's happening with the asset. But we're not unlimited resource. We're a big company with professional people, but we can't commit business suicide on every single asset. Some of these assets are only worth maybe $1 million. And if we accumulate over $1 million worth of legal and accounting expenses just to get to the bottom of it, then an investor would rightfully ask me at the end of this entire exercise, hey, Jeff, what did you spend my money on? What was the point of doing that? You know, our investors are not educators. They're not police officers. They're not a judge and jury. They are investors. They want their money back with a positive return and as quickly as possible. And that's what I'm trying to get to them. But again, we're not magicians. We cannot make money out of thin air. And oftentimes we have to use legal, accounting, and other real estate professional business resources in order to get to the bottom of things and see where the capital is and how we can reach it and how we can deploy it back to our investors.
Okay. I actually really am glad that we're discussing this, because often on podcasts you hear rose-colored glasses, everything's great and people are raising capital, and there's never a bad sponsor for some reason. I've never heard of one on any podcast. So
yeah,
it's very interesting. So
that's the beauty. Sorry for interrupting you, but that really is the beauty of a company like IRM. We have no BS. We are not selling anything. We are not raising money. We are not pushing an agenda. We were hired by RealtyShares. The way this deal is structured is that RealtyShares hired us to manage the portfolio. Our goal, and it's in our employee manual, is tell investors the truth, tell them how it is, quickly. That is what we do. Give it to them straight, because we have nothing to lose. And in all fairness, we have investors that are not happy with the news that we are delivering. And some of them have a tendency to kill the messenger, or blame the messenger, as would I. I don't like losing money, and I've invested and made money and lost money on real estate. But it's very unique, especially for me being in the industry for many years, to be in a position where you're not pitching anything. I got nothing to sell to you. The only thing I and my entire team do is tell you what's really going on. Some of it is good, some of it is bad, some of it is questionable.
Okay. So if I was a syndicator starting out, a sponsor, with all this hype and optimism, what should I be aware of on the downside? Like those people that you're taking legal actions against, how could my life be ruined potentially, or not ruined from your experience?
Complicated. Yeah, that's a great question. That's a great question. So, and this goes back to the operating agreement. So let's talk a little bit about common terminology and common tools in the world of commercial real estate. And obviously every deal is different. And everything I'm about to say is, while it's factually accurate as for the industry as a whole, it's up to the individual investor at the end of the day to understand who they're working with and read the agreements that they're signing, whether it's the operating agreement for the asset, or if we're talking about the private placement memorandum that essentially governs how their funds will be invested. All that data is important, and I always advocate consulting with a professional, if it's an investment professional or a real estate professional, because you will learn a lot from their knowledge. And as you consult with more professionals over time, you will be more of a professional and you'll be in a position to give the advice. But let me try and kind of address your question in terms of what can go wrong. The first thing to understand is that something could go wrong. And that this is in terms of critical thinking, which is a skill that I try to teach my kids every day. I think all of your listeners and your viewers should always be critical when they look at an offering. And I'm not saying be cynical. I'm just saying be critical. I found that a lot of the people on the RealtyShares platform gravitated towards deals that had a higher projected return. So if you're shopping around in a marketplace, which is probably already a mistake, we'll talk about that, and you're looking at deals and you don't know what this deal exactly is, you don't know where it is, you don't understand the risk profile just yet, but you're looking at the bottom line where it says projected IRR, right? Or projected equity multiple, and you simply look for the highest number, then you're already making a huge mistake, because those are all projected. They are expected. There's absolutely zero guarantee that is what you will get. There might be other types of guarantees baked into the offering, and that's what you should be looking for. But if you're looking at the bottom line, then you're falling for the oldest marketing trick in the book, which is, just the price. We're just trying to essentially shine a big light in your eye, and everybody makes the same mistake. They're like, oh, 12% versus 17%? Sounds like I can make more money over there. Let's sign up. That's not how it works. The old adage is correct. There is always a risk-reward equation. There is always a risk-reward balance, if you will. And it's very important to understand that. Anybody who is projecting a high double-digit return, something that starts with a 2 or in the high teens, it has to come with a certain amount of risk. And let me explain why. In the US, we work with what we assume, there are always exceptions, but we assume what we call an efficient market assumption. That means that whoever is lending the money here, which is probably a Fannie, a Freddie, a Key Bank, a Chase Bank, a large institutional lender, they've done the underwriting. They understand what's going on here. So they've already kind of guaranteed their first lien position, their collateral. You're not dealing with amateurs when you talk about commercial real estate. So someone's already looked into this. In terms of putting in the equity piece, if this was a low risk, high yield, nobody would be soliciting money from you, right? And this is how I think, in my opinion, this is how your listeners and viewers should think about this. They probably know this tip from the world of stock trades, where I think the old adage is that, if your hairdresser is telling you about a stock, it's time to sell it, not time to buy it. Because it's already such a rumor mill with people who have absolutely no idea what they're doing, that at that point, you are the product. You are the one who is being used to buy it so other people can cash out. So that's another thing to consider. If you're looking at something that's high return, it's probably with high risk. Otherwise, it wouldn't be offered to you. And that's one way of thinking of things. So I would not suggest that you be tempted with a high projected return. I would suggest that you read more about the risk profile and try to understand, to the best of your understanding, who the sponsor is and how the deal is structured. And those are really the two things worth talking about, because I'm assuming, and again, some of your listeners and viewers might be professionals who are completely capable of underwriting a deal all by themselves and have the tools to do that. But I'm assuming most people do not. Most people are probably average accredited investors. They have another line of work and they're doing this for passive income, and they have every right in the world to do that. But you have to understand that I would not walk into your office and try to pretend to be a doctor or a lawyer or a marketing executive if I'm not. I understand what it is you do, and I understand that I don't do that. So coming into a real estate, and we've seen RealtyShares people in this portfolio try to do that. They've looked at some online data and created a model, and they'll spend time approaching our customer service desk saying, well, I've analyzed the number this way. And our team of professionals look at it and they're like, wow, this guy just has zero knowledge. And it's not his fault. But RealtyShares customer service was never built to provide you with a real estate education. It's not a university. So they can just reply and say, yeah, you're wrong. And if the guy wants to know why he's wrong, well, we can't really get into that because you're so far off. But then we've seen other people who have unbelievable capabilities in terms of underwriting and understanding the cost of capital and debt structures and waterfalls. It's complicated. It's a profession. If you don't really do this for a living, you probably don't understand the minutia of every deal. So just to answer your original question, Bax, first of all, yes, something can, I don't want to say will, but something can go wrong. Looking at the projected return, thinking that's what you bought, nowhere near reality. The two major risks that I see as someone who oversees one of the largest portfolios in the world, which is not doing phenomenally well, there's two types of risk. One is the execution risk. You're essentially signing up with a sponsor that may or may not have the capabilities to do this, may or may not have the bandwidth to do it. That was a huge problem with the portfolio that we took over. Is you had people who were doing fix and flips. They were honest, hardworking Americans that did it and did it well, but they were provided with $5 million to do 200 of these at the same time, and that's where it all breaks down. You can no longer keep track of the invoices in your head. That doesn't work. You can no longer send your cousin to fix up the roof. You now have 200 units. And guess what? The mortgage keeps clicking away every month. The taxes keep clicking away every month. The preferred equity return that you promised and signed for keeps clicking away every month. So execution risk is huge, certainly when it comes to scalability. Giving someone who has a track record of doing one thing and getting them to do it on a much larger scale, disaster, a recipe for disaster, in my opinion and in my experience. Another risk is essentially how the deal is structured. And a good example of that is the second lien position. And unfortunately, again, we've seen a couple of those. That's not something that I recommend. What happens with the second lien, and for those listeners of yours who may not be familiar with the terminology, it essentially means that someone bought an asset a multifamily complex, for example. That asset had debt on it with a first lien position, usually to the tune of 65, 70% LTV, loan to value. And the rest of it was preferred and common equity. And when there's a second lien position, that usually means that the sponsor took on additional debt. And the people who invest in that are sometimes lured in by, again, big digits, right? High digits, a prospect return. But what they don't understand is that everything needs to go extremely well for the lender to be paid off, the preferred equity position to be paid off, the common equity folks to kind of make what they were making. And there's still enough money left for the second lien position to actually be worth anything. And that, in my experience, happens only 50% of the time. What ends up happening is that the project starts going sideways. The sponsor that sees that this is not going to work out lose interest because they're not going to make any money there. So they start working on other projects, and these are different LLCs. These are different limited liability corporations. So whatever they're doing with another project, you have absolutely no handle in. And then what happens is the first lien lender starts to foreclose, and they are interested at this point only in recovering their cost. And if they do that, if they're lucky to even recover their costs, that by definition means that there's virtually nothing left for you. Second lien position is very, very dangerous. That is not something you should ever, in my opinion, invest in before you have a very, very good understanding of why there's any type of value left there. So yeah, there are risks. You have to look at the deal. You have to look at the sponsor. Do not be tempted to look at the yields. That's the last thing you should be looking at.
Okay. So if I was a passive investor looking at these numbers and projections, how would I get comfortable with it? I mean, maybe I know the sponsor and I know he's got a great track record or she, and I just, how would I still analyze that if those are just projections?
Yeah, that's a great point. And let's be honest about it. When you first start out, you're not going to know. You're going to go through the growing pains that we all went through and learn through other people. That's just the way it is. So, and again, we're talking about someone who is looking to invest in commercial real estate, not someone who's looking to work in the industry for a living. That's a completely different discussion. If you want to work in the industry, you can go get professional training, including in colleges and extracurricular or extracollegiate courses where you can be properly licensed. You'll get the tools. You can work, start with an internship and then work as an assistant asset manager or work for underwriting, even in a small local shop. You will learn a lot. And within a year or 2 or 3, you'll develop tools to do this professionally. And depending on how smart you are and how creative you are and who you had the benefit of learning from, you might end up doing that very, very well. Most people are not in that category. Most people have other day jobs, and they're simply in the business of trying to invest. And then the question becomes, as you've pointedly put it forward, how do I know? And the answer is, again, when you start out, you don't know. So looking at the track record of the sponsor tells you a lot. It's kind of like any other relationship or anytime you're wanting to do business with any type of local vendor. You want to see how long they've been in business. You want to see if they have references, happy customers. You want to see if what they've projected in the past is what actually ended up happening. And looking at the track record is something that, in my professional opinion, you can learn a lot from. I think in terms of minimizing risk, working with a group that has done this before in that market, in that category, in that scale, eliminates most of the risk because they've already made a lot of mistakes and they've learned from it. And if they're still around, still in business, they're not going to want to make the same mistakes again. Doubling down on somebody new or somebody who's been doing this but not in this market, not in this category, not to this scale, is a gamble. Could it possibly work and you can make a killing? Absolutely. But in terms of your risk profile, it just went through the roof. Doing this with somebody who has done it before, in that market, in that scale, in that asset category, guarantees that they have people who have done it, vendors who have done it. They've worked with lenders, they worked with tax providers, they worked with contractors. They know something they already know, certainly a lot better than you and I, because we don't do this for a living. So that is key. Second, I would look at the way the operating agreement is formulated to see what kind of protections you have. Some of the things we hear a lot about in this business are corporate guarantees and personal guarantees. And this is something that I run into a lot with the portfolio that I oversee, which is a huge portfolio in terms of scale, one of the largest in the world. But about 25% of it is in complete default, what we call tier 3. And some of those cases in the tier 3 actually have a personal guarantee. And what I find through talking to customers, we have thousands of customers. I don't speak to all of them. We have a director of customer service and a whole team of customer service reps that are trained and have access to data that can help these investors. But occasionally I speak to some of them. And what I hear from them is, I signed up for this deal because I read on the website that there's a personal guarantee, which means if this thing doesn't work, the sponsor is going to pay for it personally. And I listen to that and I'm like, yeah, that's not what it says, and that's not how it works. The reality is you have to look at a personal guarantee. A personal guarantee is only worth what the individual is worth. So if you have an individual that doesn't have a net worth of $5 million, they can't really guarantee that if the project fails, they'll give you. They don't have it. And unfortunately, a lot of the people who sign a personal guarantee are people who don't have the funds to back it up. Because the people who do, they usually don't sign guarantees. And the unfortunate reality is that, and we get some, I have to say I was in some heated conversations with some investors who were rightfully screaming and shouting, go after the personal guarantee, sue this guy. You have to understand what that means. It means that we're going to take whatever money is left to sue somebody. We may or may not be successful, because once you go in the court system, which is a completely different route than commercial real estate, you need to hire a lawyer. That lawyer needs to show up. He needs to show up in the right jurisdiction. He gets paid by the hour. You stand in front of a judge. If you have COVID, you get a 6 months delay and you don't meet again for another 6 months. You still have to pay a retainer. You still have to keep everything on file. You eventually get a judgment like we did. You actually win the case. You get a judgment against the individual. The individual says, yeah, I don't have that kind of money. So now you have a judgment, but you're unable to collect. So you go to a collection agency, and then the sponsor files for bankruptcy. These things happen all the time. So the notion that you have a personal guarantee means very, very little. What does matter is your ability to collect and whether or not you have the resources to follow through legally. And some of these investors have a burn it down mentality. It's like, I don't want my money, but I want to sue that guy. I get it. These are retail investors. These are people like you and I. I don't like to lose money either, but I have to keep a calm level head and try to make decisions that are in the best financial interest of all of the investors. And I don't necessarily always think that spending whatever money is left on suing a guy who will never pay anything back is the right financial decision. It's a balancing act, and it's difficult, and that's what I get paid to do. And we have a team of professionals that weigh all the options. We always get a third-party BOV, a broker's opinion of value, to understand what we think the asset is worth. And like I told you earlier, we hire private investigators, and occasionally, not always, and forensic accountants, and we ask for bank statements and tax statements to try to understand what it is that we're going after. But things can go wrong, and when they do, it's not always pretty. And the fact that you have a personal guarantee doesn't mean you'll get anything. And some of our investors in our portfolio have learned that. And again, I don't want to draw a picture that everything we do is all bad. We're focusing on the bad because it's interesting for the podcast. It's interesting for the viewers. It's not all like that. The majority of people that are currently our customers are getting all of their money back plus a nice return. But there's a small portion who don't, and they are rightfully vocal and they complain, and I would complain as well. The question is, what can you do with the agreements that you have? I can't just do whatever I feel like it. I'm bounded by these agreements. So yeah, it does get very complicated.
Okay, and it almost seems like the 80-20 rule, again, it's kind of applied to everything. And this is really what you're saying, the last quartile. So that makes a lot of sense. Huh. And would you say, you said mostly it's multifamily deals. So in that bottom quartile, is it also multifamily, or is it spread across different asset classes?
That's a fantastic question, and I'm glad you brought it up. It's one of the insights that we see at IRM across this portfolio. It is not. It's actually the opposite. The multifamily category, we have multiple categories, but the multifamily category, with very few exceptions, tends to be the most resilient asset category. And the way we've analyzed it at IRM is there's three reasons behind that. And again, I want your listeners and viewers to know that what I'm about to say is not a guarantee of anything. It's just a statistical data point that we find while observing this portfolio. So take it with a grain of salt, but this is how we see it. First of all, multifamily complexes tend to be more expensive than single family. By the way, there are exceptions. We have single family residentials that are in the $10 million range and multifamily that are lower. But usually you're talking about someone who's a little bit more of a professional if they go buy a multifamily. Your average run-of-the-mill flipper, right? Someone who buys and flips in his local neighborhood, less likely to get involved in a multi-million-dollar complex commercial multifamily operating deal. And the reason that's important is because what we just discussed. As soon as you have a professional in the picture, as soon as it's a company that has been around for years, maybe generations, that has an accounting department, a property management department, a capital markets department, you are already eliminating a lot of the risk on the execution side because you're dealing with people that know what they're doing, which means they've done some professional grade underwriting. They're going to manage this with people that have been doing this for a living. They know how to deploy CapEx. They know how to do maintenance on the property. They know how to do rent optimization. They know how to work with government-sponsored programs like Section 8 and HUD and vouchers, if it applies. You're already talking about minimizing some of the execution risks simply by being in this category. The other thing we've seen is, and COVID is a fantastic example of this, is while other market segments, while other asset categories can get hit, and anything could get hit, multifamily tends to be more resilient because at the end of the day, people need somewhere to live, period. So if you look at the last 6 months, you and I were talking just before we went on this broadcast, I haven't been to my New York offices in months. I'm frequently in our Dallas offices. I've been to our Salt Lake offices, but since COVID hit, I haven't been to our New York office in almost 6 months. We're still paying the rent, but we may not continue to do that. And we are just one data point. We are a reflection, an example of what many other companies are also thinking. Hey, with COVID, we're going to start doing more remote. We may not need office. We may not need as many office buildings. We may not need as many units. So that entire asset category of office space, whether it's vertical or horizontal, may get hit. It is getting hit. We know that for a fact. Obviously, we own a bunch of those. We have government offices. In some of the cases, in some of our office buildings, the government is the tenant. And they're not renewing contracts because they're also seeing a change in behavior, right? The way their employees are deployed out. But those people still need to live somewhere. Same thing with malls. I haven't been to a mall. I don't know about you. I haven't been to a mall in months. Not looking forward to it. Same thing with other types of shopping centers. Hotels. I have been. I still travel for work, and I've been to hotels both domestically and internationally recently. But I can tell you there were not a lot of people there. Some of our hotels are hit very, very hard. Single-digit occupancy in some cities in the country. That's not sustainable. So you can see with all these examples that multifamily tends to stay resilient, even in global pandemics. Another thing that happened is that with the CARES Act, there were a lot of protections and some financial incentives that were given directly to residences of multifamily. So, and by the way, we make that distinction. If you're living in a multifamily, you're a resident. If you're renting an office, you're a tenant. That's a little bit of the professional lingo differences. So residences in multifamily tend to be a lot more resilient in these kind of times for the reasons I've described. You still need somewhere to live. You may get some government assistance, and you're less likely to see a shift because, again, while offices and malls and hotels can get hit, multifamily still, for the most part, collecting the rent. So we find that multifamily is more resilient for those reasons. Again, a professional grade developer already eliminates a lot of the risk, and that category tends to be more resilient. In the single family home, we tend to see a lot of sponsors that may or may not be considered professional. And again, I'm not talking about a guy with, 2 of his cousins in the back of a truck. That happens as well. That's not professional grade. And again, I'm not putting any of them down. Some of them are hardworking, professional, honest people, and some of them do a good job. But in terms of a risk profile, that's a high risk profile because you're going to pay for someone else's mistakes. Well, if you go work with a professional sponsor that's been doing this for 30 years and they have a manual of books and procedures and contacts and networks and track record, you've eliminated a lot of the risk. So the higher, generally speaking, the more expensive the property, probably a lower risk profile in terms of operating. Because of the nature of how this works, it needs to be a professional grade player that's involved. When you go into single family, it could be the guy's first, second, third time he's doing it. You don't know. Well, you can ask, but you don't really get an institutional level filter if you work with the smaller asset categories.
Okay. That makes a lot of sense. It's very interesting. So that basically the succinct answer to the question would be a lot of single family in that bottom quartile.
Oh yeah, for us right now, I would say the most dominant category in the tier 3 are the single family residential, the SFR. Absolutely.
Okay, interesting. Yeah, I don't even really think of them as raising capital. A lot of it's just people maybe pooling friends and family money. But I guess it makes sense. I don't always monitor the crowdfunding platforms.
It's funny you say that because that's exactly the conversation we just had for about 10 minutes. Is this the kind of risk profile where you want to bring in accredited investors on an institutional scale, or is this more of a friends and family thing? I think the question of scalability, and in real estate, this is very, very tempting. And I'm sure some of your viewers and listeners know this because they probably have some hands-on experience. When you buy a rental property or you buy a fixer-upper and you do a flip and it works, it's like a light bulb goes on. You're like, whoa. What am I working so hard for a paycheck when I can do this? It just went so well. The market is going up. I know what I'm doing. I'm a bit of an architect. I have great taste. I'm a great manager. I'm a blah, blah, blah. And it builds up a lot of confidence. And why not? It's great. That's fine. But some people take a leap of faith and leverage, which is the act of taking on debt. Debt has this annoying tendency, you need to pay it back with interest. So they take on debt and they scale and I'm going to do 5 of these. And then what happens is 5 might be, like we said earlier, a lot more complicated than doing 1. And as every day that goes by, you have to pay the interest, you have to pay the taxes, you have to pay the mortgage. And it's not only the scale, is that a lot of it, and we're all guilty of this across the entire industry, a lot of it has to do with the cyclical nature of the economy. So if you were flipping houses in Miami or Vegas in 2006, you thought you had the golden touch because practically everything you did was just trending up and people were buying and prices were going higher and higher and higher. The only question is, when did you stop and cash out? Because when 2008 rolled around, the market is very, very cyclical. And we all know what happened in 2008. I'm not suggesting that's happening again, although anything is possible. But that was a big bubble, a big real estate bubble that bursted there with the entire CMBS fiasco. But what happened to real estate prices, regardless of the reason, is that they started going backwards. So what happened to your golden touch? What happened to, I'm a bit of an architect? What happened to, I'm a great project manager? I'll tell you what happened to it. You lost a lot of money. That's what happened to it. Because it doesn't necessarily correlate to your skills. And that is key. Let me say that again so your listeners can let this sink in. Your success doesn't 100% correlate to your skills. You can be smart, you can be diligent, you can be honest, you can be hardworking, and it will all, at the end of the day, get messed up. And that's happened because you take on a lot, and if the market changes on you, you still have to pay the debt, you still have to pay the taxes, it stops making sense. At some point, the financial cost is so overburdened that you have to sell them take the loss and just cash out and run away. And that also happens. By the way, it also happens in commercial real estate. So one thing to remember is it's a marathon. It's not a sprint. If you're doing this and hoping to make a quick buck, get rich fast, you're in the wrong line of work.
Okay, that's very interesting. Well, as some of my listeners might know, I also work in bankruptcy. So before we go, I was curious. I noticed RealtyShares has officially filed a Chapter 7 bankruptcy in July of this year. So how does that relate? to IRM, because I noticed y'all are like one of the largest creditors. It's only like $6 million in debt, but are you familiar with that process at all?
I'm not. And again,
Okay.
we're not RealtyShares, so I can't really comment. I also heard about it, but I don't know the details, and I don't know if that was finalized. And I've learned my lesson not to believe anything you see on a blog or any even newspapers. And whether that's actually transpired or finalized, I really don't know. We operate under what's called an MSA. It's the Master Services Agreement. So again, the way the deal was structured is, again, we were hired by RealtyShares to manage their portfolio. And I got to tell you, I got to give them credit. I know a lot of people are angry at them, and we hear and we see that, we hear the voices and we see the posts. The people that I got to interact with when I was still doing it, and when I was still interacting with them, when they were still around, were real professionals. And they said, listen, we still got money in the bank. We're not going out of business, but this thing is not continuing. And we want to hire a professional asset manager. The only thing we want you to do is do the best that you can for RealtyShares investors. And that's what we did. Like I said, IRM is not soliciting anything. We're working on a kind of a break-even basis. This is not something that is earning our shareholders a lot of money at all. In fact, if anything, our shareholders are risking a lot of money. We have almost $1 million worth of legal expenses out there that we may or may not recover. IRM might end up losing money on this engagement, but we did it because we thought it was the right thing to do. We thought that letting 9,000 or so investors, hardworking Americans, moms and pops, doctors and lawyers and airline pilots and people who invested in commercial real estate, some of it real estate that we're also involved in from our shareholders' perspective, was not the right thing to do. We didn't want to let them fall. We wanted to help those people maximize what was already done. And I keep saying this, we're not magicians. We cannot make money out of thin air. Some of these deals are bad. Some of these sponsors are bad, and some of these deals have lost and will lose. But to a great extent, the overwhelming majority of deals in this portfolio, dollars in this portfolio, and investors in this portfolio will cash out with a return. And the only thing that my team and I do, and again, we work under the power of this management services agreement. RealtyShares hired us to do that, and we continue to do that aggressively every day to the best of our ability, and we're not perfect. We always ask ourselves, all right, any decision that we're allowed to make in this portfolio, a lot of times we're not, nobody even asks us. But if there is a decision point, a juncture where we get to make a decision in this portfolio in every single deal, we ask ourselves, all right, what will return the most amount of money to RealtyShares investors? Sometimes we may get it wrong, who knows? But we certainly work with professionals. We certainly work with key data points. We always get BOVs, we get estimates from lawyers. We have really tier one professionals in this country working on those deals. I don't know what's going to become of RealtyShares. That's above my pay grade, as they say, but we're still here, we're still working. And listen, if someone ever, if a court shows up and someone tells us that we have to stop, we'll stop. We'll all go back to our regular jobs working for our shareholders. And we'll do that. But for now, our plan is to keep managing out the RealtyShares portfolio for the next year or two. It's a question of projections on how long these deals will last. And we intend to fight for every investor, for every dollar, as much as we reasonably, responsibly can.
Okay. Yeah, hopefully they don't have a Chapter 7 trustee come in and be liquidating assets. And I don't know, because I noticed they did file a Chapter 7. It's starting to get a little too technical, probably for everyone. But
well, just to explain one thing, RealtyShares and IRM now, we don't own these assets. It's the investors that own membership units in these assets. We are the appointed manager, the asset manager, sometimes referred to as the servicer. Some of it is debt and some of it is equity. Our job is essentially to hire people that know the industry, to oversee these sponsors, collect the distributions, pay them out to investors, what we call pro rata, right? So everybody gets their proportion of the distributions, collect the tax documents. We try. Some of these sponsors are no longer in business, don't exist, give us bad data. That happens as well. But this is what we do. And in some cases where we have, not always, but some cases we have rights under these operating agreements, we can remove the managing member and take over it and sell it for what it's worth and give people their money back. In some cases, We look for deficiencies in the operation, and on behalf of investors, we sue to try to get the money back. Sometimes sue for the personal guarantee, as we've discussed in this chapter. But these are the things that we can do. We are not the owner. We are not the developer. We didn't buy this. We didn't operate this. We don't operate it now. We only work as a professional party that kind of groups all of these investors together and try to take the best actions on their behalf based on what we can and are allowed to do, not based on what we think would be ideal. I wish that was the case. And most investors get that. I think, you know, our customer service desk gets a lot of thank you notes. I've never in my history have I seen so many. And I think a lot of people are appreciative of what we do and how hard we work for them. Well, we absolutely don't try to sell them anything at all. That's not our business model. We came in here to try to do the best that we can with the situation we were handed. And it is a challenge, but I don't think a liquidation, again, a liquidation, if a Chapter 7 comes through, it's not really a question of somebody taking these assets from these investors. The investors own them. And as long as we're around, we'll continue to manage them based on what we can do per the operating agreement, try to make the best decisions. Our goal is to get people their money back with interest as quickly as possible and move on. Because as you've indicated, RealtyShares is really no longer around as a functioning entity. And I think all these people want their money back and the freedom to move on to do something else. So my goal is to get them their money back as quickly as possible so they can move on with their lives.
Yeah, that's a good point. The assets aren't actually assets of the estate. So those don't exist to liquidate anyway. So,
exactly.
Okay, cool. The last question I had, I noticed that you're also an airline pilot. Throw you a curveball here. Can you talk about that a little bit and like how that compares to real estate investing and just how do you balance both jobs?
Yeah, so first of all, it is true. I'm an airline pilot for a large airline in the US, but I'm not an official. I can't mention their name or I can't speak. I'm not authorized to speak on their behalf. I just work there. Yeah, you'll find a lot of people that have multi-disciplines, I think in leadership and in real estate. I think you're an example of that as well, and probably a lot of your listeners. You know, real estate is something that is, I always say it's not rocket science, that you have to learn the lingo, you have to respect it as an industry. But if you're interested, and I am, in doing multiple things, then I've always indulged in kind of other things. I've been an airline pilot for almost 20 years, and it's the nice thing about the aviation world, at least on the pilot side, is that you have some level of control over your schedule, and it's not the type of job that you take home with you, right? So I don't have to wake up in the middle of the night for the airline and look over presentations or worry about the board of directors or look over agreements, because that's not my job. My job is to fly the plane, and as soon as we set the parking brake and everybody's safely off, I thank you very much, and I'm off. I have days on and I have days off. So I've been able to kind of juggle both things. A lot of my colleagues in the airline industry also have other gigs on the side. I actually find it extremely beneficial, to be honest. A lot of the disciplines and the methodology that I use as a manager in the tech and in the real estate tech space comes from airlines. Everything about setting structures and working with procedures. I've learned a lot. I've learned from all of my mentors and all of my jobs, but the cross discipline, if you will, of bringing methodologies from airlines. You know, airline is the safest form of transportation in the world, and that is because of a principle that we hold dear, and it's something that I use with my team in real estate, and it's called the debrief. We essentially, everything that we do, whether it went well or it didn't go so well, we debrief it. We don't sweep it under the rug. We don't pretend it never happened. We get together and we say, all right, listen, hey, what just happened here? What could we have done better? What is the root cause of this error? But it doesn't have to be an error. It could be something that we did well. But what is the root cause of this thing? And how, if it's a good thing, how can we encapsulate it, memorialize it, make sure that the people that are coming up through the ranks behind us get to use that knowledge? And the same thing for something that went wrong. And things do go wrong. Don't get me wrong. We're not perfect. My team and I at IRM probably have a debrief once a month. We all get together, and I always lead by example by saying, hey, this is something that I messed up this month and I want to share with you. This is why I did it, I think. It could be a communication problem. It could be a data entry problem. Again, nobody's lazy and everybody's a professional here, but we still occasionally, it's the inevitability of human error. We're all people. So that's something that we do bring from this aviation discipline of having to debrief what went wrong, what can we do better, what kind of processes or controls can we put in place to make sure that next week when we do a multi-million-dollar distribution, we get that one exactly right. And it's phenomenal. I've seen myself get better and grow as a professional, and everybody on the team that I work with has learned from that. And that is a skill that I've acquired in a different industry. So multidiscipline definitely has its moments.
Okay, it's very interesting. I just asked about it because I've also heard that before takeoff, there's a series of checklists and procedures, just like you said, and it can also often compare to due diligence on a deal, and just at least check all the boxes and all that stuff.
You're so right. You're so right. And that's a great example. And that's another tool and skill set that we've kind of migrated, that we've adopted from aviation. Everybody at IRM works with a manual, and we have checklists for the main procedures that we do. So asset updates, asset exits, distributions, everything has a checklist. And the concept of a checklist, even in real estate, which is something that I think your viewers and your listeners can benefit from, is you basically encapsulate the knowledge even from other people that are not around. Because as you list down the steps that you should take, and sometimes you don't even understand it. Sometimes you look at a step and you're like, why am I doing that for? But if you do it, you're pretty much guaranteed that you're going to avoid errors that happened in the past. And that's where checklists come from in the world of aviation. You start, we always say in aviation that these checklists were written in blood because someone died, probably, or something big happened. We've put it in writing to avoid that happening in the future. So real estate is not that dramatic, but again, nobody likes to lose. Nobody likes to make a mistake. So by following a due diligence checklist, a closing checklist, a pre-acquisition checklist, and we do it again with distributions, we do it with quarterly reports. We have checklists for all of the major components of what our team members do. And they follow checklists. And I'll tell you what, every now and again, less and less, but every now and again, somebody comes up and says, hey, we could have done this better, but it wasn't in the checklist. And we all get together, debrief, and say, that's a great idea. And we update the checklist. Doctors do it. Airline pilots do it. I would advocate that most professionals follow a written procedure because it lets you learn from other people's mistakes. It also is a great tool when training new people, even if they're very experienced. These are the steps that we follow in this company. You follow step 1, 2, and 3, pretty much guaranteed if you check all those boxes that you didn't miss anything. And that's a great tool, and it helped us many times before. And I think that's exactly the type of professionalism that we bring to this industry. And that's, again, I'm not trying to badmouth anybody else, but some of these other platforms don't work that way. They think it's about tech, or they think it's about marketing, or they think it's about talent. And it is all those things. But bringing in some institutionalized, medical style, aviation style procedures and checklists lowers the risk. It guarantees you're doing a more thorough job. And that's exactly what these RealtyShares portfolio investors deserve. And that's exactly what we bring to the table.
Okay. Well, it's definitely a higher note to end on. So if our listeners want to learn more about you or get in touch with you, is there a website or any other place to point them to?
Yeah, of course. So, and we're always happy to end on that note. So IRM is not soliciting anything. We don't operate a website. If you are a RealtyShares customer, you, for now, continue to go to RealtyShares.com. Everything you see there is operated by us. So if you need to get in contact with customer service, if you have a question about an existing deal, anything that you want to do, just reach out through those contacts. It will come to me and my team, but that is the way to go, because we essentially operate their assets. We are not them. But we operate their assets in their absence. Our shareholders, both Into, spelled with a double I, or Reef, spelled with a double R, are large operators of real estate, crowdfunding platforms, operators of real estate in the space. And I think everybody should, anybody who's trying to learn about the space should visit both of those websites to learn about what those two companies are doing, and if they decide, participate in their offerings. Absolutely.
Okay, perfect. Yeah, I'll be sure to put those links in the show notes so that people can easily access those. But really appreciate your time today and talking about this, and just really helping to paint a clearer picture of kind of both sides of the equation when it comes to doing these deals. So thank you very much.
Thank you for having me. I think it's a great podcast, and I think you're doing a great job with giving people real knowledge. It's not just a marketing scheme. You're not just pitching the next product, but really people that want to learn and have a dialogue and meet professionals in the industry. It sounds like this podcast is the place to go.
Yeah, exactly. That's definitely our goals. Thank you.
Thank you. Thanks for having me.
Sure. Okay, there's our episode with Jeff Holzmann. I hope you really enjoyed it. I feel like he painted a really clear picture of the both good and bad side of investing in real estate deals. And what I found interesting that applies to a lot of different things is, although you can sue someone, it's always about if you can collect. For my own portfolio, for example, we've evicted tenants before and gone to court, got the judgment, and just weren't able to collect. So if you can't collect the money, it's kind of all not worth it. And in his case, if you're paying attorneys high legal fees, then it only serves to further reduce the recoveries on the initial investment. And one thing also I found interesting that he and other guests on my show have said, when it comes to vetting a sponsor on a deal, you really need to look at how long they've been doing it, how familiar they are with that market, and really what infrastructure and business do they have in place, so that way you can minimize the execution risk and the just overall risk of the deal. He said that the bottom quartile, bottom 25% of the portfolio that they're winding down is often less sophisticated sponsors that are maybe doing single family types of fix and flips and just have a really difficult time of scaling it because it's just a whole different business model. So all really important stuff. Also, of course, checking references and making sure that other investors are happy, and see what's going on with deals that sponsor did a few years back. Make sure that they haven't lost interest in it and just don't manage it anymore. Again, if you feel inclined to do so, please leave us a review and subscribe if you haven't already. I hope you enjoyed this episode and hope you tune in to more coming forward. Thanks a lot.